we're in a period of extended mediocrity. Are we, Priya?
Yes, so I think the labour report, was a little bit weak, but in our view, it's a lagging indicator. I'm still struck by the fact that aggregate income continues to decelerate. So if we're all hanging our hat on the consumer that's supposed to continue to spend, aggregate income is slowing. Where's the engine of growth? So we are in this mediocrity aspect, I hear you, but if there's no engine of growth, the Fed, I don't think this really changes the Fed. So the Fed is on hold. So we really need something here to boost growth. That's not coming from the labor market. And therefore, I think this year is going to be a little bit difficult. We're going to be in this narrow range. We all have to trade that range because this was not enough to move the needle. But it's not giving me a whole lot of comfort either.
Gershon, your take?
This comes on the heels of what was a gangbusters number last month, right?
Yeah.
Had it only been good last month, another good one, right? We kind of averaged it out. We'd all be feeling a lot better here. I think we have to get used to we're not going to get a whole lot of information from these payroll numbers going forward. If you look at either the medium term or the long term kind of rolling averages, we're 175 to 200,000 over any of those time periods, and that's enough. That's to create jobs for people entering the workforce, to spur consumption. It's not gangbusters. It's not, if you look at the hourly wages, they were a little bit weak on the margin. That's going to give the Fed comfort that we're not going to see inflation, going to put them on hold. But it is a ho-hum number.
George?
Yeah, I agree. The average hourly earnings number ticking down a little bit is something to just watch. Not something concerning right now. We're thinking it's more of a kind of a two-cubed environment, right? You get 2% growth, 2% inflation, and roughly 2% yields.
Keep hearing this.
You're going to have to trade in between those ranges. So you're not going to probably get too significant of a move.
Hearing variations of it anyway. We had Rick Reeder of BlackRock on the program this week as well, and he was saying that it's going to be 1.8%-ish inflation GDP on the 10-year as well. Does that resonate with you, Priya? It
does. I do think, there are a lot of risks out there. And the Treasury market should price in these risks. I think Treasuries right now are pricing in a Fed on hold, inflation kind of staying here, but not really pricing in all the risks. I mean, I would say business uncertainty. Just a week ago, we were dealing with US-Iran. There's still, the Middle East is still pretty unstable. We've got an impeachment, we've got an election. So I actually think Treasuries have room to rally. So I would say the 10s can get below 180, below 2%, because we've certainly taken out the hiking scenario. So there's a cap on the 10-year. And if any of these risks start increasing, I think Treasuries are actually an attractive risk hedge to any asset out there.
So our audience are fully informed, though. You also think the Fed comes back in at some point this year?
We do.
How does the Fed come back in it this year? Because pretty much everyone I speak to thinks the Fed is done on the sidelines and nothing brings them back in whatsoever.
So if you tell me that growth is indeed 2%, that there is absolutely no slowdown in growth, then I think the Fed is on the sidelines. Our view is that a combination of, slowing business investment, manufacturing is still pretty weak, that actually does affect the consumer through the course of the year. Plus, I'm really concerned that when the Fed stops buying treasuries, which I don't think is happening for the next 6 months, but at some point they're going to put enough reserves in the system and take a step back, that you get a tightening in financial conditions, where the market says, wow, this QE help to financial conditions is behind us. And at that point, does the Fed say that, look, we still don't see any inflation and we've actually seen the tightening, maybe we need to put in a little bit more accommodation. And there's no inflation fear, so what's the cost of adding some more accommodation? So we do think the Fed comes back in.
A couple of points to unpack then. The Fed comes back in. One, the second point, the balance sheet issue. Let's begin with one. Gershon, your view. The Fed could come back in at some point this year and think about cutting interest rates. Does that resonate with you in any way, shape or form?
Yeah, I think it does. And I think that's what the equity markets are banking on. Right? The equity, it's still, to us, it's the dichotomy between the two markets is still staggering. Right? Look, 2 weeks ago, was anyone talking about Iran? That wasn't on the list. We had a lot of the known things. We don't know what's going to be tomorrow. There are a lot of risks out there. Right? The Brexit's still unresolved, rising populism in the world. We can go on and on with the risks. Equity seems to be just taking it in stride. People are just, they're sitting there, they're comfortable. We're not going to have inflation. We're going to be low rates for a while. And people still think there's a Fed put. I think that we're still not sure how we're going to resolve this. You still look at manufacturing. You look at business confidence. It's not telling you the same thing as the employment numbers and consumption are telling you. History will tell you you're going to have one of those two kind of revert to some type of mean. Which one is it going to be? If we do start to see a trend where we get more ho-hum numbers on the employment side, we see consumption start to roll over, the Fed's going to come back into play. Should they is a different story, but clearly they're going to.
George? They want to be accommodative here, and they've been very clear about that. I think there's a huge hurdle for them to raise rates. To lower rates, though, don't think it's quite as huge. I think they want to use guidance. I think they want to remain on the sideline and just watch things as they go along. But I think right now, if they're given the druthers and if information declines at this point and starts going down, they're going to step in and start
I think many people agree with you all that the risks are skewed asymmetrically to cuts over hikes. What people will struggle with is trying to establish the threshold for a material reassessment of the outlook. And Priya, just a little downside surprise here and there doesn't, to me, translate as a material reassessment of the outlook. Are you saying we don't need a material reassessment, or are you saying that we will actually end up getting one at some point this year?
So our view is that you will get this material reassessment. I mean, it may not be material enough for a recession. I think what we've heard from the Fed is expansion of the recovery. You know, they've continued in the last few months. I think they've actually changed the reaction function here, because they're telling us that because they want to get inflation up to target and beyond, they're actually okay tolerating an overshoot. So any weakness in growth, so material is sort of subjective, but I would say if you get payroll growth closer to 100, I think they're going to be back in cutting rates.
George? Yeah, I think to your point, from a data perspective, you're right. They're going to allow inflation to run a little bit hot here. They want it, in fact. The challenge is, to your point earlier, if liquidity starts drying up, if they are running into that challenge, they might need to then do that. But the reaction function specifically is the markets themselves. They're going to be watching the markets dictate somewhat what they need to do going forward.
See, I actually don't think it's a catalyst as much as there are secular trends going on that are just going to end up slowing growth in the long term. You know, it's easy to point to President Trump as, being the cause of the trade war. There are bipartisan tendencies, not just in the U.S., around the world, much more protectionist, much more populism that, regardless of who wins in the White House in November of this year, there's going to be more volatility around trade. It's not only in the U.S. Australia, we're seeing it. We're seeing it in the U.K. It's not just about Brexit, right? There's a populism going on. There's more protectionist instincts around. That's going to put a damper on growth worldwide. Yeah. And at some point, it's going to slow growth. And central banks have, in our view, probably mistakenly think that their job is to control economies and to prevent downturns and recessions from ever happening. And the laws of economics haven't been repealed yet. There are still shocks. There are going to be cycles. They can't always save the day.
As you've pointed out, it's not about what they should or shouldn't do. In this game, it's about what they will or won't do. You made 2 points, Priya. One was about the debate we're having at the moment over rates. The second point was about the balance sheet and the communication problem they could bump into in the middle of this year. Put all of that into all of that. The balance sheet operation around the conversation that we've just had in the last 5 minutes.
Right. So I think the Fed has been essentially injecting a lot of liquidity in the system to prevent another sort of repo spike. They have been very successful. So, we had been hoping for this. The fact that they put as much as $500 billion available actually allowed repo rates around year end not to spike. But now what? Now what they have to do essentially is keep buying bills to offset these repo operations. The problem is, even though the Fed continues to tell us this is not QE, it looks like QE. They're actually injecting, reserves are growing, the balance sheet is growing. Our forecast is that they will be buying bills at $60 billion all the way up until the second half. So if it is June or July till when they're buying, the market loves that because there's more liquidity in the system. When the Fed steps back, I think they're a little bit in a trap. How do they take back that liquidity or stop the liquidity injection? Because the market who thinks this is QE is going to say, wow, that's one form of injection that's gone, easing, and therefore financial conditions need to tighten. And I'm worried that that'll actually bring the Fed not to buy more bonds, but then they'll have to come into ease.
Given all of that, what do you think the biggest weight is sitting on top of real yields right now? From everything we've just discussed at the moment, what do you think it is?
I think it's a net supply issue. So net supply of treasuries, remember we were talking about deficits forever? We still have a lot of deficits. But last year, US treasury debt to the private market was about $1 trillion. This year, we're estimating about $600 billion. So you have, even if I assume unchanged demand, no further increase in demand because of all the geopolitical risk, unchanged demand, but my supply of debt to the market is just 40% less, that's going to just keep real rates very low. It's good for risk assets as long as the economy stays okay.
Final word, George.
The technicals are definitely favoring fixed income right now, and I think that's very true. I think right now the market it's operating on liquidity, it's operating on optimism, and it's operating on momentum. It's not operating on fundamentals. That could happen for a short period of time or pretty prolonged period of time, but not for the long term, and that's going to have to turn around.